Marcus put $10,000 into Bitcoin in January 2014. Sarah put $10,000 into a total market index fund the same month. They are both 28. They work in the same field, live in the same city, and had the same conversation before deploying the money. $1,000 per month, saved for 10 months, finally ready to commit. Marcus had been following Bitcoin since 2012. He understood the thesis. Fixed supply capped at 21 million coins. Decentralized ledger. Growing merchant adoption, long time horizon required. He bought 12.99 BTC at $770 per coin. Sarah was not interested in the thesis. She was interested in the track record. She opened a Roth IRA at a low-cost brokerage, bought a single total market index fund at an expense ratio of 0.03%, and set up automatic dividend reinvestment. Here's the thing. 10 years later, the headline numbers appear to end the debate before it begins. But the headline numbers describe two experiences that look nothing alike in practice. And the difference between what Bitcoin returned and what the average crypto investor actually received is the number that matters most. This video is that number. Let's start with what Bitcoin actually did. Marcus's 12.99 Bitcoin, held continuously from January 2014 to January 2024, was worth approximately $545,000 at Bitcoin's price of roughly $42,000. His $10,000 became $545,000, a 54 times return over 10 years. Annualized, that is approximately 48% per year compounding forward. Sarah's $10,000 with dividends reinvested continuously grew to approximately $28,400 over the same period. The total market index fund returned approximately 11%, annualized from 2014 to 2024. Her $10,000 became $28,400. But here's what. The comparison is $545,000 versus $28,400, a factor of 19. If those were the final numbers with no further context, this video would end here and the case for crypto would appear closed. Those numbers are not the final numbers. Now let's talk about what Marcus actually experienced to arrive at $545,000. Bitcoin lost 86% of its value in 2014, the same year Marcus bought. The Mt. Gox exchange, which processed approximately 70% of all Bitcoin transactions at the time, collapsed in February 2014 and took 850,000 Bitcoin with it. The price fell from $770 to approximately $170 by January 2015. Marcus's $10,000 became $2,200. He had been invested for less than 12 months. He held. Bitcoin recovered slowly through 2015 and 2016, then accelerated through 2017 as retail attention and institutional commentary drove a speculative cycle. By December 2017, Bitcoin reached $19,000. Marcus's position, held without interruption, was worth approximately $246,000. Then it fell 84%. Here's the thing. Bitcoin dropped from $19,000 to $3,200 between December 2017 and December 2018. Marcus's $246,000 became approximately $41,600 over 12 months. During that decline, Bitcoin was covered extensively in financial media as a failed experiment, a speculative mania that had run its course. He held through that too. Bitcoin ran again through 2020 and 2021, driven by institutional purchasing and pandemic-era monetary expansion. By November 2021, it reached $69,000. Marcus's position, now worth approximately $896,000, represented an 89 times return on his original $10,000. 17 months later, Bitcoin sat at $15,500. His position had fallen to approximately $201,000, a decline of $695,000 from peak. He held a third time. By January 2024, Bitcoin recovered to approximately $42,000. Marcus's 12.99 Bitcoin was worth $545,000. And here's the part that separates what Bitcoin returned from what most Bitcoin investors actually received. Investment research consistently documents a gap between an asset's return and the average investor's return in that asset. In equity markets, Dalbar's annual quantitative analysis finds this gap runs approximately 1.5% to 2% per year, caused by investors buying after strong performance and selling after drawdowns. In crypto markets, the same behavioral mechanics apply at larger amplitude. On-chain transaction analysis of Bitcoin purchase timing shows that the majority of retail buyers entered during two windows, late 2017 and 2020 to 2021. These are the periods of maximum media coverage, maximum social discussion, and maximum price enthusiasm. The median retail buyer did not purchase at $770 in January 2014. Their weighted average entry price sits closer to $25,000 to $30,000. But here's what. An investor who bought $10,000 of Bitcoin in December 2017, at the first all-time high that drove mass retail entry, and held through all subsequent crashes to January 2024, received approximately $22,000. That is a 2.2 times return over 6 years, with 3 separate drawdowns exceeding 50% along the way. The S&P 500 returned approximately 2.1 times over the same 6-year window, with a maximum drawdown of 34% that recovered in 5 months. Marcus bought at $770 in January 2014. The comparison his outcome invites is not the comparison most people who invested based on his outcome actually experienced. Now, let's talk about the altcoin problem. Marcus did not hold only Bitcoin for 10 years. Almost no retail crypto investor does, because the thesis for holding only Bitcoin in an asset class with thousands of alternatives requires a level of conviction that most investors abandon within the first major market cycle. By 2017, Marcus had allocated portions of his portfolio to Ethereum, Litecoin, and Ripple. The thesis was straightforward. Bitcoin is digital gold, Ethereum enables smart contracts, and other protocols will capture specific use cases. Diversification inside crypto seemed rational by the same logic as diversification inside equities. Here's the thing. By 2020, Marcus had added Chainlink and Polkadot. By 2021, he had a position in Terra/Luna, a stablecoin ecosystem with an algorithmic design that many analysts considered innovative. Terra/Luna collapsed to effectively zero in May 2022. Approximately $40 billion in market capitalization was erased in 72 hours. It was not a gradual decline. It was a structural failure. Sarah's index fund held approximately 3,700 companies simultaneously. The worst-performing companies produced losses absorbed across the full portfolio without eliminating meaningful capital. No single holding could inflict catastrophic damage. The Marcus's altcoin diversification introduced concentrated failure risk at exactly the moments when price enthusiasm was highest, which is also when position sizing tends to expand. And here's the part about taxes that changes the comparison after the headline numbers. Sarah held her entire position inside a Roth IRA. All contributions were post-tax. All growth is tax-free on qualifying withdrawal. Her $28,400 at year 10 is the number she actually keeps. No capital gains event on withdrawal, no tax drag on any growth accumulated over 10 years. Marcus held his crypto portfolio in taxable accounts. Every rotation, selling Litecoin to buy Chainlink, exiting Terra/Luna before the collapse, moving from altcoin positions back into Bitcoin during bear markets, triggered a realized capital gains event. Short-term gains on positions held less than 12 months are taxed at ordinary income rates. For Marcus's income bracket over the decade, that rate ranged from 24% to 32%. But here's what. A crypto investor who rotated their portfolio multiple times per year, a conservative assumption given the typical behavior of active crypto participants, generated tax liabilities in each high-gain year that required liquidating additional positions to cover. The compounding effect of recurring tax payments is not a rounding error. It is a structural reduction in the investable base that accumulates over 10 years of active management. Sarah's total market index fund carries an annual turnover rate of approximately 3% to 5%. It generates almost no realized capital gains distributions. The tax on her gains is deferred until withdrawal, at whatever her marginal rate is in retirement, which for most investors is lower than their working year's income rate. The structure compounds in her favor without any active decision on her part. So what does the 10-year breakdown actually show? 3 things, and none of them are crypto wins or index funds win. First, the assets return and the investor's return are different numbers, and in crypto, the gap between them is large. Bitcoin returned approximately 48% annualized from January 2014 to January 2024. The median retail Bitcoin investor, entering at purchase prices weighted toward peak market cycles, received a fraction of that. The 54 times number is real. It belongs to Marcus, who bought at $770 in January 2014 and held through 3 crashes. It does not belong to the investor who read about Marcus in December 2017 and bought at $15,000. Second, the path is not separable from the return. Bitcoin's 10-year return was produced by 3 drawdowns of 77% to 86%. Those drawdowns are not a side note to be discounted. They are the mechanism. The return exists because most investors did not hold through those conditions. The investors who held through them received the return. The investors who sold during the drawdowns received a different, smaller number. Behavioral durability under those specific conditions is not evenly distributed, and it is not predictable in advance. Third, account structure and tax treatment change the final number. Sarah's Roth IRA compounded tax-free for 10 years. Marcus's taxable crypto portfolio generated capital gains events throughout the decade, reducing his investable base with each rotation. Before the comparison between $545,000 and $28,400 is treated as definitive, it requires adjusting for the tax paid on Marcus's gains, the after-tax number Sarah actually keeps, and the ongoing tax advantage the Roth structure compounds forward into retirement. Marcus arrived at $545,000. The number is real. The path required buying at a price most retail investors never accessed, holding without selling through 3 crashes that destroyed 77% to 86% of peak value each time, managing concentrated altcoin exposure including at least one position that went to zero, and absorbing tax consequences across 10 years of active portfolio decisions. Sarah arrived at $28,400. That number is also real. It required opening one account, making one investment decision, reinvesting dividends automatically, and not selling during a 34% drawdown that lasted 5 months. The 10-year breakdown does not say Marcus was wrong. It says the experience of actually holding Bitcoin through 3 major crashes is not the same as watching Bitcoin's price history on a 10-year chart. And the gap between the asset's return and the investor's return is the number most people skip when they make the comparison. You already know which experience you would have had. This is what we do at Vaulted Finance. The kind of money math that doesn't make the headlines but quietly decides how the next 30 years of your life actually play out. New breakdowns drop here regularly, so subscribe if you don't want to miss the next one. And drop the topic you want us to break down next in the comments. We're reading, and the most requested ones are the ones we cover first